Hey everyone. Yesterday in class I said that I would find a time for us to get together today so that we could review how to execute simulation analysis using at-risk. I actually think we'll just do this in video format. That'll be easier and we'll get better coverage for everybody. So we're going to record what I hope is a short video just to review and remind you of how to use at-risk and to think about how you could use it for a DCF model to do simulation analysis. Again, you could use this for any model that involves inputs regarding the future, right? Any inputs regarding the future are going to be uncertain, and so you could transform those into probability distributions, and then you could execute hundreds or thousands of iterations. That's the idea here, is transform static inputs into dynamic random variables. So let's just jump right into it. Here is my DCF model for Carnival Cruise Lines. You will remember that there are a lot of components that go into this DCF model. So for instance, and I'm not going to go through all of it, but we had to make a revenue forecast, and we did a revenue forecast for the next 3 years, 2018, 2019, and 2020. The way that we did this is we went and got some industry forecasts for the number of passengers in the global cruise industry. It also had market share data for the most recent year. So if we assume a constant market share for Carnival Cruise Lines, we use those global forecasts for cruise passengers, then we can get a forecast for Carnival Cruise Lines passengers. And then using historical data in the 10K in terms of passenger ticket revenue and onboard and other revenue, and how many passengers that they actually carried. Again, this is all coming from the MD&A section of the 10K. Then we realize that this is the per passenger revenue that we've generated the last 3 years. Taking the average of that or using the last year, then we can say, well, we think we're going to carry this many passengers. We think we're going to get this much revenue per passenger. That's how we did our revenue forecast. We also had to do net capital spending. We had to make a fuel expense forecast. So I'm not going to walk you through all that, but I just want to remind you, there are a lot of assumptions, a lot of uncertain assumptions about the future going into this discounted cash flows model forecast, not to mention this steady state growth rate, which we've talked about. So, and again, I just want to give you a flavor. I'm not going to try to do the whole shebang here. But it might be reasonable for us to acknowledge how uncertain a lot of those forecasts are and to replace some of those variables with distributions, random variables, and then run a bunch of iterations and see what our output looks like. Right now, I have an intrinsic value of Carnival Cruise Lines of $82.46. Right now, Carnival Cruise Lines is trading at $65.15. So I'm getting a buy or a strong buy recommendation here with this intrinsic value. But things can change. Things can be very uncertain. Just as one example, when I tried to forecast my fuel expense, you'll remember what we did is we tried to kind of figure out, okay, based on how many ships do you have, how much oil are we consuming, and then we did a forecast of how many ships we would actually have out on the ocean during each month of 2018, and based on that we had an average number of ships of 104 and 92 out there. Okay, based on 104 and 0.92 ships out on the ocean, and we estimate that the consumption was going to be this right here. So I can't remember the scale on that, but 3,347 tons, if I remember right, of fuel. So anyways, we were using all of these estimates. 104 ships out there. There's our consumption. That's the price per metric ton. That's the fuel per ship. And so anyways, these are all these inputs, but one of the big inputs was the price of oil, right? We tried to say, well, in the past, oil prices were $48.70 a barrel, $43.30 a barrel, $50.80 a barrel. That got us to our price per metric ton. So then we tried to use this to estimate what our price per metric ton would be in 2018. But that estimate right there, which is the price of oil per barrel, that was coming from the futures market. So we looked at futures data a few weeks ago or about a month ago when we made this estimate. And based on the futures data, we thought that the average price per barrel of oil this year would be about $60.09. So again, that projection of our average price per barrel of oil derived our price per metric ton. That's what we think we're going to consume based on the number of ships outstanding. So if you multiply all this across, right, you're going to get our fuel expense. So these are main drivers. This estimate of the price per barrel of oil, which led to our price per metric ton, or our cost per metric ton. So this stuff all matters, but it's all very uncertain. I wanted to show you that that estimate that we did is completely wrong. Because if you go and look at oil prices right now, if I can find it up here, you'll see that crude oil is already at $64.85 a barrel. So these future prices were way off that we looked at about a month ago. Look, that's just me trying to prove to you that the inputs in this model are very uncertain. We've already seen some of our inputs move drastically. So we want to replace these. And I'm not going to update this. I'm going to say this was our estimate. I'm just showing you we know they're wrong. So maybe what we want to do is we want to come in and we want to replace this estimate of $60.09 a barrel, and maybe we want to let that thing drift a little bit. So I would replace it with a normal distribution. And maybe we would start with our average of $60.09, but maybe I'm going to give it, I don't know, a $4 standard deviation. Why a $4 standard deviation? Well, if I wanted to take more time, I would actually go and figure out what the distribution of oil prices has looked like. But I'm just using a 68.95.99 rule, right? What does the 68.95.99 rule say? If you go 3 standard deviations on either side of the mean, that's going to be your 99% confidence interval. So if I put a $4 standard deviation in there, what does that mean? That means go $12 down and $12 up from $60.09, and that's going to be our range. So back of the envelope, our range, our 99% confidence interval is going to be $48 to $72. But anyways, we do that. And now, if we do a bunch of iterations, that's going to draw from that normal distribution, and we're going to get an estimate for oil prices that will be somewhere between $48 and $72, and the average will be $60.09. We might do the same thing with revenue. We might come back here and say, well, I don't know if I can trust that my market share is actually going to be 47%. So maybe we replace this with a risk normal distribution. 0.4731 will be our average, but maybe the mean will give it a 1% standard deviation. So what does that mean? 3 standard deviations below, 3 standard deviations above. That means back of the envelope, our range is going to be between like 44% and 50%. So we do that. And we do it for all 3 of these years. And maybe we do the same thing for our revenue per passenger. Maybe we replace it with a risk normal, and the average is going to be 1424.07, but we can see that just over the last 3 years it's been as low as basically 1400. So in order to get it down to 1400, then maybe I'm going to give it a standard deviation of $8, right? We do that. So if our standard deviation is $8, that means we're going to go $24 down, $24 up. That's our 99% confidence interval. So that means our bottom line would be like 1400, top line would be about 1450. Then maybe we come back to the DCF and we say, man, this steady state growth rate, we know that that exerts a lot of influence, so we're going to put a risk normal in here. And for the average, we're going to put 0.0416, which is what we had. And then maybe for a standard deviation, we're going to do 50 basis points. Maybe I don't want to do 50 basis points. Maybe I'll do 25 basis points. So 25 basis points means that my steady state growth rate is going to be bounded by, roughly speaking, like, what would that be? 3.4 and maybe 5.1 or no, 4. What would that be? 4.9, something like that. So anyways, 3 standard deviations would be 75 basis points, go 75 basis points up, 75 basis points down. That's going to be our bound. Then we would come down here and we would identify our intrinsic value as our output. So I would just put my cursor on the $82.43. I would add the output. I'm just going to name it my intrinsic value. Click OK, and hope that your Excel doesn't lock up on you. Okay, so now that we've got a few variables transformed, by the way, you could do the same thing with your WACC. You could say I'm not 100% sure that my WACC is 8.2%. So maybe I'm going to do risk normal, 0.082. And then maybe I'll give it a standard deviation of, again, maybe 25 basis points and, 0.25. Let me double check and just make sure I did this right. Yeah, that's 25 basis points. Up here, I did not make that 25 basis points. I made it 25%, which we certainly don't want. We want it to be 25 basis points. Okay, so there we go. So now what we have is an average of 8.2 on the WACC. 25 basis points is our standard deviation. 4.16% is our average on the steady state growth rate. 25 basis points is the standard deviation. And then for revenue and fuel, you remember what we did. So now we're just going to do, like, I don't know, let's do 500 iterations and see what we get. So I'm going to place my cursor right here on my output. I'm going to click the Start Simulation. It's going to take it just a second to crank on that. We're going to pull it up. Okay, and then it's nice. It's already got our 90% confidence interval. So our 90% confidence interval is from $20 up to $317. That's not that useful, actually, because that spans all the way from a strong sell to a strong buy. But you can do things like this. You can say, all right, well, we know right now that the price is roughly $65. So let's take this down to like $65. Take this one all the way to the limit on the left side. So I'm getting 36% of my iterations are either at or below the current market price. So I would say 36% of my recommendations or 36% of my iterations are going to result in a hold or a sell recommendation. If we take it on the other side, so like it's got to be, let's say, north of 75 for me to issue a buy recommendation, because that represents at least over a 10% return actually. So if we go to 75, then you can see I get basically 55.6% of my iterations result in a buy recommendation. How many of them would give me like a strong buy recommendation? So maybe north of 80. So 53% of my iterations are a strong buy. 55.6% are a buy or strong buy. And then, like we mentioned before, 36.6% would be a hold or a sell recommendation. So look, I'm not putting this in my analyst report, but this is helping me quantify the uncertainty. Remember, we said that there's this RIM ties you up acronym, right, in your analyst report. And as you're thinking about this as an analyst, you need a recommendation, you need an intrinsic value, you need to know your methods, you need a thesis, you need industry, economic, and supporting data. But the U, RIM ties you app, and just to finish it off, AP is aesthetically pleasing. The U represents uncertainty. So this simulation analysis is helping me wrap my mind around the uncertainty. So, okay, come out of this, yeah, I get $83.96, right? That was my static best case intrinsic value estimate of the DCF model. That's clearly a buy or a strong buy. But when I actually went in and did my simulation analysis, I'm realizing that really only about 55.6% of my recommendations represent buy or strong buy. So I'm not going to come in too emphatically on this, right? I'm going to realize that depending on what happens, if these oil prices go the wrong direction, if my steady state growth rate is lower than 4.16%, if our market share doesn't hold at 47.31, if for some reason our revenue per passenger doesn't hold at 1424.07, then there's a decent chance we don't arrive at a buy recommendation. So I think I'll stop it right there. I just wanted again to sort of show you how to do this at-risk simulation analysis, and again just show you that this is a very valuable way to quantify and visualize the uncertainty that's kind of intrinsic and inherent in all of these analyses that we're doing. Hope that's helpful. Very much looking forward to your presentations here over the next 3 class periods. Let me know if you have any questions.